Okay, so in the short term, we learn perfectly competitive firms either can make abnormal profit, normal profit, or economic loss. If they can cover at least their average variable cost at the given price, they will even continue with losses also in the short term. Now we are going to check what is going to happen in the long run for the perfectly competitive firms, right? All these things we discussed. Here, long run equilibrium. In the long run equilibrium, they have, since it's the long run, these perfectly competitive firms can adjust their capacity, right? They can change their input. Now there is no fixed variables, fixed input. So they can change the size, building, their capacity. Likewise, they adjust their plant, then they can go to the production where they can reach the minimum point of average cost. So the cost minimization they can achieve in the long run by adjusting the plant size. Now imagine now here they are functioning at somewhere here, not at the minimum point of the average cost, but in the long run they can reach there by expanding the size and achieving the minimum long run average cost. So we say in the long run, firm will be earning normal profit. So there is no abnormal profit or losses in the long run. Perfectly competitive firms anyway will make normal profit in the long run. We are going to check how that happens. Let's suppose let's say here there is a one firm with no, there in this market now all the perfectly competitive firms are making profit. Okay, so now they are making profit means here if we refer the diagram, they are making abnormal profits here, right? They are functioning like this with abnormal profit, excess profit. If that's the case, what happens? Existing firms get incentives to increase the scale of production. If you are making more profit, you will be motivated to produce more, right? The existing firms. Now let's suppose we are here Now entire this part is their profit. Now what happened? Because of the excess profit, existing firms get incentive to increase the scale of production. Now they want to produce more. Instead of limiting here, limited to this quantity, they will increase the quantity to earn more and more profit. Taking this as an incentive. Then what happened to the market? Now let's go to the market here. This is market price, okay? This is market quantity. This is the market demand. This is the market supply. This is where the price is determined. This price is taken by this particular individual firm. Understood? No? Market design price එක තමයි එයා ගන්න production එක කරන්නේ. Now at this price they are making abnormal profit. Now they are more motivated to produce more with the higher profit. So all the firms in the market, all the existing firms in the market will produce more. If they produce more, what will happen to this supply? දැන් ඒගොල්ලෝ production එක වැඩි කරනවා ඉන්න ඔක්කොමලා. එතකොට මොකද වෙන්නේ ළමයි market supply එක? The supply will increase or decrease? Increase. Decrease. Increase. So the supply will increase, right? Now let's say, now our new supply is here. Supply increases. When the supply increases, what happened to the price? Price decreases. Price decreases. When the supply increases, price level will fall, right? Now the price is here, not here. Now always an individual firm in the market is a price taker. So they have to take the new price here. Now what happened? At this price, this is now their MR. MR equal MC happened here. Now the average cost is higher, right? So eventually it will come to a point the average cost is also like going like this because it's in the long run. So eventually they will end up where the price is equal to the average cost and thereby making the normal profit. Understood? So eventually they will downward shift in the demand curve here, individual demand, downward shift එකක් වෙනවා. Thereby they will end up with normal profit. Okay, can you please draw this scenario? I recommend you to take this graph to the left side. Market එක individual firm එක අනිත් පැත්තට. So first take the price. So and make sure your average cost normal profit against the value. And first time I missed that. Okay. Right. So that is one scenario. If the firm is already, if all the firms are making abnormal profit in the short run, the existing firms will have incentive to produce more. It will cause their market supply to shift leftward or shift downward, making the price lower, thereby eliminating this abnormal profit in the long run, settling where your price equal to the average cost with the normal profit. Did you understand that? So my diagram was wrong at the first. You have to make sure that your AC is equals to the P at the second scenario. Okay. Or else there can be another scenario. Okay. Now, all other firms who are not at the market at this moment. Remember, this is perfectly competitive market, perfect competition, free entry and free exit. So anybody who wishes to enter to the market can freely come to the market. Now, if the others observe, okay, in this market, there is profit now. No? So they will also get motivated to enter to the market. Then what happens? New firms will be attracted to the industry. So the new firms will come to the industry. If the new firms coming to the industry, then what happens? Now these individual firms in the market making abnormal profit, forcing new firms to come to the market. New firms are attracted to the market. Then let's say this is the factor market. This is the factor market, total demand and supply. Let's suppose this is labels in the market. Abhi to me X here, X is like close example for perfectly competitive market. Now the X sellers are making abnormal profit, so all other new people are motivated to be an X seller, so they enter the market. Now, they will need factors of production to produce this market, supply to this market. So, they will demand more and more input. Input demand is category. For an example, maybe they will demand more chickens. Chicken, not even with the or else they will demand the laborers to continue these farms, to start the new farms. So let's say this is the labor demand. Labor demand will increases. Labor demand will increases. Now this is the first wage rate. Now this is the second wage. Understood? Now this wages going up means what happens to the average cost? Now demand for it, because there are new entrants, demand for input increases. So input prices increases. When input price increase, average cost also increases. So it's like this. Now this is their MC. Here they are. This is the average cost. So at first they are making abnormal profit and supplying this quantity. Now, because of this abnormal profit, new firms are arriving to the market. So the factor demand increases, the prices increases for the factors, so the cost goes up. Now what happens? Your cost will go up like this. This is your new cost. It will go up. Now what happened? Your average cost is equal to the price. So again, you will end up at normal profit in the long run. So this is how these perfectly competitive firms come into the normal profit. It can be two ways, either by increasing the supply by existing firms or by arriving the new firms, thereby increasing the input cost. Okay, draw this also. You have to write down this thing as well, okay? Any cyberknife, the minimum market you know. Therefore, the average cost increases. That's why we are keeping the average cost down. Okay. Now this is what happens if the market is with abnormal profit. Here, this is the same story, no? Now, when the market supply, when new firms, no, when already existing firms are supplying more, this is what we draw at the first scenario. The supply curve shifts downward, increase in the supply, price decreases. So at the end, you will end up here with normal profit. But in the short run, it could be abnormal profit. Right? Short run method nan hittiye, where MR equal MC happens higher here. But the average cost short run here. So entire this part in the short run is abnormal profit. But when you reach the long run with the lower price, you reach to the normal profit scenario. So here, if we take the short run curves also at this point, they are also coming to normal profit scenario. Understood, no? Because always we know this long run curves are collection of short run curves, right? So at this point also, this is a short run of equilibrium also, right? Now what happened if there are economic losses in the market? Now there are losses, not abnormal profit, economic losses. Now what happened? Existing firms may fit from the market, right? If the loss is not enough for them to cover at least the avoidable cost, then they will decide whether to shut down or not. And also, other firms will think of reducing their size, right? In order to minimize the loss. So then what happened? If the firms quit the industry supply will decrease the other way around. When the industry supply decreases, what happened to the price? Price will increases. So when the price increases, there is an upward shift in the individual demand curve. You will end up at normal profit. Similarly, if some firms cut down the size of the production, now new firms are not encouraged to enter no, when they are making losses. If existing firms cut down their size or the production quantity, then the factors of the demand for the factors of production will reduce, thereby lowering the input cost. So the factor prices will decrease. There will be a downward shift in the cost curves, thereby arriving to normal profit. So can you start up with the situation with the economic loss showing individual firm economic loss? Then please draw the two set of diagrams for these two scenarios. Economic loss දෙකක් ඇඳලා මේ වෙන දේත් එක්ක මොකද වෙන්නේ කියලා. Okay. Okay. Shall we continue? Then if we talk about the long run equilibrium, it's like this. Right? When we are reaching the long run equilibrium, where the long run marginal cost is equal to the marginal revenue, which is the price, short run also comes to the equilibrium at that point. So the short run marginal cost and long run marginal cost, long run average cost, everything are equal at this point here. Okay. Now, when we are talking about perfectly competitive firms, there are two conditions that we have to remember. We say these are perfectly competitive firms. No, the name itself explains they are doing a perfect competition, no discrepancy, no like disparities, right? Perfectly, pure competition, right? They are not competing in like secret ways, or they do not have any other source of competition like advertising or product changes like attributes or quality wise. No, the product is same, homogeneous. So they are doing a pure competition, right? So if you are going to this firm or the other firm, you are getting the same product. So like perfectly competitive. So it's depend on the consumer. He will decide where to go. So we say these firms have two types of efficiencies because they are perfect competitive firms. First one is allocative efficiency. The other one is productive efficiency. What is allocative efficiency? That means allocation wise. So when we are talking about these firms, any firm takes some resources which is scarce in the market. So they take scarce resources, then they do a production. So they allocate the resources for the production. Then that production also allocated among the consumers depending on their demand, right? So this allocation is very efficient for the perfectly competitive firms. Why? Because they are settling at a point where price equals to the marginal cost, right? එතකොට ඒගොල්ලෝගේ price එක marginal cost එකට සමානයි. MR equal MC or P equal MC for the perfectly competitive firms. So they are charging a price which is exactly same as per their marginal cost. Understood? There is no price change. They are not charging the price above their marginal cost. Understood? So they always, for the other firms, it's not the case. We will learn in a minute when we are talking about other market structures. But for the perfectly competitive firms, P equal MC. Others, MR equal MC. But for the perfectly competitive firms, these two are same. P equals MR. That means always they are charging the same price for the additional cost they incur. So if they increase the production by 1 unit, the addition happened to the cost is the marginal cost. So for that, they charge the same price, right? So we do not change the price, the same price. So they are charging a price which is equal to their marginal cost. Kind of very fair allocation, right? So when we say when this price is equal to the marginal cost, P equal MC, that is allocative efficiency. That means they are fairly, efficiently allocate their resources in the market. So the people also paying a price which is equal to the firm's marginal cost. No gap between the marginal cost and price. But this happens because perfectly competitive firms, there are large number of firms in the market. So they cannot control the price. They have very low bargaining power. They control over the price is very less. So they cannot charge whatever the price they want to do, right? The only way they are making the profit is by adjusting their average cost. Price and as it is average cost whether they are making abnormal profit or normal profit or loss depends with the average cost. Price is taken. Understood? So they are like charging a very fair price. So in other words, we are saying that is allocative efficiency where price equals to the marginal cost. If any firm charging the price which is exactly equal to their marginal cost, then we say that is allocative efficiency. That means these resources are fairly or efficiently allocated. Understood? And also, they have productive efficiency as well. Because when their price is equal to marginal cost, where AC is minimized, especially in the long run, they reach to the equal MC, where the average cost also at the minimum, right? That means they are reaching the productive efficiency as well. So they can, in the long run, minimize the cost coming to the lowest point of the average cost and charging the price which is equal to the marginal cost. Understood? So perfectly competitive firms, we say they are economically efficient. This economic efficiency, there are two ways. Economic efficiency, allocative efficiency, and productive efficiency. Allocative efficiency means P should be equal to marginal cost. Productive efficiency means P should be equal to marginal cost when AC is at minimums. Okay, so both of these two conditions are met only by perfectly competitive firms. So we say they are very economically efficient firm or market structure because they have both allocative and productive efficiency. Understood? So other firms cannot achieve these two conditions. Only the perfectly competitive firms do so. Right. With that, we can finish the perfect competition. Can you do this question? Do this review question by yourself? Okay, done. We've completed. Do the question number 2 as well. Okay. Okay? No? This is very easy. No? Shall we discuss? Okay? Right. So the second, we'll start with the second question. They say, assume that the taxi industry in the town of New City is perfectly competitive. Also assume that the constant marginal cost of a taxi ride is 5 rupees per trip. So now they have not an upward sloping marginal cost curve, but a constant. MCA ka constant එකක් කියන්නේ. 5. And that each taxi is capable of making 20 trips a day. We will let the demand function for taxi rides each day be quantity demanded equal 1100 minus 20p. Now first one, what is the perfectly competitive price of a taxi ride? How much? How much? Huh? 100 per ride. 5, right? So because we know in the perfect competition, P equals MC, no? That is the first condition there, no? So now we have given marginal cost is 5. So the price should be also equal to marginal cost. So it should be 5 rupees per ride. Then how many rides will the citizens of New City make every day? Then how do you do that? For this demand function, which is QD equal 1100 minus 20p. Now we know price is 5. You substitute 5 there. How many rides? 1000 rides. Then how many taxis will operate in New City? How many taxis? They say one taxi is capable of making 20 trips a day. එක taxi trips ඉස්සක් දුවන්න පුළුවන්. They need altogether 1000 trips, 1000 rides. So how many taxis we need? 1000 divided by 20, 50 taxis, right? Okay. Now the first question. So suppose there is a perfectly competitive industry where all the firms are identical with identical cost curves. Furthermore, suppose that a representative firm's total cost is given by this, where Q is the quantity of output produced by the firm. You also know that the market demand for this product is given by the market demand is given, and also market supply is given. The first question is, what is the equilibrium quantity and price in the market? You just have to equate the market demand with market price. Market demand is here. P equals 1000 minus 2Q. Market supply is 100 plus Q. So when you simplify, what are the price and the quantity? Price is 400, quantity is 300. Then what is the firm's profit maximizing level of production, total revenue, total cost and profit at this market equilibrium? Let's come to the second part later. Now we have to find the profit maximizing level of production. So how are we doing that? You can either follow total approach or marginal approach. So first, anyway, we have to find the total revenue first, right? So the total revenue equals P into Q, right? So the demand is given here. 1000 minus 2Q, right? So we have to multiply that by Q again, right? 1000 minus 2Q into Q. So we have 1000 Q minus 2Q square. So the marginal revenue should be equal to 1000 minus 4Q. No? What happened? What did you do? You like change the way to get. Okay. So now since you know the price, you just took total revenue equal 400 Q. Remember that? No? What happened? If you like substitute the price 400 here, you can say total revenue is 400 Q as well. Say that, right? Then how about the marginal, total cost? Total cost is this one, 100 minus 100 plus Q square plus Q. So you can find the profit. Profit equals total revenue minus total cost. Then you can take the profit function. Then you can simplify and take the quantity. What is the quantity you got? 200. I mean, actually. What happened? 200. How about the rest? Here, the quantity 300 is the market. Price 400 and quantity 300, that is for the market. But here we are finding the profit maximizing quantity for individual firm. Definitely Q 300 can become a substitute. Still, can you rewrite again? I have that here to take the this is the sum. Lecture. And that for the some meaning. think it's better to recap your understanding on profit maximization. How to solve this? There are two approaches that we can use to find the profit maximizing quantity. Okay, total approach and the marginal approach. What do we do on the total approach? We find the total revenue, we get the total cost. First step is total revenue minus total cost, we get the profit function here. So now this is total cost, this is total revenue, this gap in between is the profit. Here in this region, we can see the total revenue, so total cost is greater than the total revenue. So it's a loss. But here we can see it's a profit. Now we have to find where it is maximized now. So in parallel with this diagram, if we draw the profit function, we have a negative, then it will come to a positive. So we have to find at where it comes to this positive, right? So normally, if we draw this, it goes like this, profit function. Now we have to find what is the quantity here, where the profit is maximized. For that, what we have to do, we know in the profit function at this point, the slope is 0. So the total approach, first step is you find the profit. The second one is you have to find the slope of the profit function to check whether it's 0. Fine. Because we know slope should be 0 at the maximum. So you differentiate the profit function with respect to Q and equal that to 0. That's the second step. But we cannot conclude there by here also the slope is 0, but it's a minimum point. So we have to make sure this is a maximum point. To do that, we do the third step where we get the second derivative of the profit function. And it should be what? The value of the second derivative should be positive. Should be negative, right? Less than 0. Why? Because if it's a maximum point here, we know after that it is going to decline. Downward slope. So it should be negative. එතකොට ආය පාරක් අපි differentiate කරාමන්නේ negative කියන්නේ it follows a negative slope. So there is a maximum. But if we are here, we are getting a positive value after that, upward slope will appear. So if this is greater than 0, that means we are not here, but here. So to make sure we are not at the minimum but at the maximum, we have to take second. Understood? And check whether it's negative. So these are the 3 steps which involve in total approach. If we take the marginal approach, what we do? In the marginal approach, first step, we are differentiating the total revenue with respect to Q. We get the marginal revenue. Second step, we differentiate the total cost with respect to Q. We get the marginal cost. Third step, we equal marginal revenue to marginal MR equal MC. Then fourth step, again to make sure we are at the maximum, not at the minimum, the slope of marginal cost curve should be greater than slope of marginal revenue. How do we get the slope? We marginal revenue differentiate. Then we get the slope of marginal cost, marginal revenue. Here. Okay. So these are the three or the two ways that we have to follow all the steps under the two approaches to find the profit maximum quantity. Now, if you follow one of these steps, you can easily find the answers for the first question here. This one. So you now know marginal revenue equals to price now in the perfectly competitive firms. So the marginal revenue should be equal to 400. Right? Marginal revenue 400. How about marginal cost? Since this is your marginal cost, you differentiate this one time. So here, marginal revenue is 400. Marginal cost is 2Q plus 1. So you have to equate these two. So it's like 399 divided by 2Q. So Q is 199 plus something if you follow this approach, but closer to 200. Total approaching out, you get the 200 as it is. Both the answers okay. Understood? Okay? Here, total cost, we have to differentiate one to get the marginal cost. So 100, they cancel that. There's no Q terms. Q squared becomes 2Q. This Q plus 1. So the 2Q plus 1 is the marginal. Redek mema karan 1 minus in 195 or 199 something තමයි එන්නේ 199. Rate approximately 200 කියලා. වෙනවාට ඉස්සරහට total revenue, total cost, profit ටික හොයාගන්න පුළුවන්. You just have to substitute the value, right? So if you follow the other approach, what you do? අනිත් පැත්තට හදලා මොකද කරන්නේ? This is our total revenue. This is our total cost. මෙයාගෙන් මෙයා අඩු කරලා we find the profit function. Do that also. ඒකත් කරලා බලන්න ඕන answer කියන follow the same method. You know, moment in class we will just Okay. So it's now now here, please listen carefully. They are given us market supply and market demand. Understood? Market supply, market demand. By equating these two, what do we find? Market price and market quantity. Okay? So that we know, since this is the perfectly competitive firm, we are taking the market price as it is. So if we find the market price is 3, how much? 400. 400, we take it. So the P for the one particular firm is 400. So for their total revenue, P into Q. So 400 into Q. Total cost for one firm is given. Understood? Then what do? We have total revenue, total cost. We can follow the approach here. If we follow the total approach, profit equals total revenue minus total cost. 400 Q minus this one. Simplify, you get this one. Then you have to differentiate the profit function one time to find the score. If you differentiate, you get here. Q equal 199.5. Then you have to make sure this is a maximum. So the third step, You get the second derivative, it should be negative. -2 negative. And profit function में R par differentiate करने with respect to K is -2. So it's here that 0. Then it's a maximum point. We are getting the same answer. Here also 199.5. Then you have to find total revenue, total cost profit for the firm, not for the market. If it firm make a few and firm. Understood? Okay. You can use whatever the approach you like. I think the easiest one is this one. Marginal approach के तकदार आपने बोलवा के बारे में सीधा तकदार आने same. Okay. Right. Now I want you to log into LMS and I have uploaded the case study and some discussion questions related to perfect recovery. It's actual case study. So can you please group how many students are there? Okay. Can you make 4 groups? 4 by 4. And you can arrange the series, download the case study, discuss, and find the answers for the discussion question. Because I do not want to start the new session now, which is on monopoly, because I have prepared the quiz after the perfect correction. If I start the monopoly now, I might feel you will confuse with some of the questions. So let's start it after this. Let's check after the quiz, madam. Let's do a small case study. Okay. Maybe you can join first row and this. Or do you like to do that? Yeah. I'm going to take that. Yes, I think I'm going to get a clear discussion. So, if I start monopoly now, yeah, we talking maximum when I say automatically you might do that in the quiz. Very interesting, is not. I am going to do it like this. The group of girls and boys have to team up. So we are doing a case study. You can join one. Okay, can you please mark your attendance as well? If you cannot mark the attendance, I will manually do, okay? First try. If cannot, let me know later. I'm going to ask you to present each question. LMS is not loading, no? I think there's some issue with the LMS. We'll see. We'll mark the attendance later. You guys continue with the case study. Did you guys download it? Acre. Okay, who failed to mark the attendance? Can you come up with the number? Huh? 22, okay. 29. 29. In the next page. Three. Tipa. 3 already marked. 12. 23. 23 present. No. 12. What's the number? 1, 2. Twelve. 12, okay. 2, okay. Who else? Okay. So you have only 10 minutes more, okay? Then you are supposed to provide me the answer. So shall we discuss? Ready? No? Five minutes more. Okay, shall we discuss? Okay. Now, any volunteer group to discuss the first answer? First question. Okay. Why is the US potato industry considered close to perfect competition? Cannot hear. All others, please listen. Many producers and 9,000 plus potato firms. Many producers. Then largely identical. Because farmers can set average between crops to their activities. Okay, so here this case study is about potato industry in US, a real case, right? There, the specialty is here. They, if you read the article carefully, they at one point they argue most of these agricultural products belongs to perfectly competitive industries. Did you find that paragraph? They say most of the time agricultural communities belongs to perfect competition. What is the argument? Why are they saying so? Yes. First one is there are many producers and many buyers, right? And also somewhat the product is homogeneous. And also the individual firm cannot control the price. So most of the time they are taking the whatever the price determines the market, right? And also the government intervention wise in delays, and also they say that mobility of factors of production like the factors like your land and other things you use to do this production could be easily shifted to another crop. Potato, from potato to another crop. Likewise, mobility is there. Therefore, they say these agricultural commodities are closely related to perfectly competitive market. If I rephrase the question and ask you, can you argue the other side? No, potato is not a perfectly competitive market. What is your argument to support that? If you want to argue, no, potato is not perfect competition, yes? What are your arguments? Price control, especially this case study is about some potato supply management program. So that means the government intentionally control. Now, intervention is there. Then we cannot say free market mechanism is there, right? Purchase. Entry barriers could be there. And if you notice that here in the case, yes, in the case study they mentioned, even though the potato in nature is somewhat identical or homogeneous, depending on the state, the price is different, right? And I'm gonna state they get very lower price, and some states get higher price. If it's a perfectly competitive market, can that happen? No. Price is equivalent. So you get counter argument as well, even though we align that with the perfect competitive firm, but it cannot be other way around as well, right? So the product changes also may be there. They also provide some categories in the potatoes, no? Potatoes, they are not. Right. Okay, what is the second question? How do supply management programs deviate from the perfect competition outcome? Compare price, quantities, and firm profit. Any group are going to answer the question? Which group? Second question, can you? One year. So in your final exam also there can be a case study. Yeah? Not a big one, but a small case study where you have to read and answer. Thinking of that. You can get the practice here by doing it. Any other group? Okay. Then what happened? What happened to the property, price, quantity? Now they have given you a good graph to explain all these things, no? Here. Here, this one. Now, did you check this? No? This is the very important part. Now, the problem here in this case study is now they say at the time in US, overproduction in potatoes happen. People or the producers overly produce. When the supply is over, what happened to the price? Price goes down. So they said the profit of the potato producers is very low. Sometimes most of them make losses. Right? Yes, because of this excess supply. Then they compare the prices and the quantities also, right? There's a nice graph over here somewhere. Here, before this supply control, can you see? This is the production, this is the price. So the price is very below, but the quantity produced is very high. So overproduction, that was a problem. They said some states, their price was well below the production cost even. So they made losses. So this government and these producers, these like the coordination of these producers, they had to take the decision to overcome this issue. So that's why they introduced this supply control or supply management policies by them. What did they do under supply management policies? To reduce the supply. They provide quotas maybe, and also the some prices. What else? Marketing campaigns. What else? What else did they do? Yes, the land area, they control like, the quotas and everything. So they wanted to control the supply and boost the price up. Now, they compare all these situations with this particular diagram. This is very important, okay? So this is for the market. That's why we do not, this is not for the individual firm, but for the market, we have a downward slope in demand curve. Here they say this QO is the quantity that they overly produce. That means before the supply management policies. So what is the price that the buyers willing to pay for that quantity? PO. Now, this is their marginal cost. They assume a constant marginal cost. So, this is their marginal cost. This is the price. Now, at this QO production, they are making profit dollars. Profit. Now, this is their marginal cost number. Make a marginal cost figure. So, this is where they are. Right? So this is the price, this is the marginal cost at this quantity. So what they make? Losses. So it was a huge problem. Then they evaluate at least if they take this market and push it towards a perfectly competitive market structure, what would happen? Then what happened? Here, this is the quantity they expect under perfect competition. This is marginal cost. Now what happened? Price is same for the marginal cost, right? So do we have profit or losses? No, P equal MC. Allocative efficiency is there. But at least we are not making losses now. If the market went towards perfect competition. And here this S point S is the point that they say if they introduce this supply management policies, what they can do. Then you can see now the price is a little bit higher than the marginal cost. Then they can earn some profit. But if they assume that this market goes to a monopoly, we will discuss what is monopoly next. Then they can make extra profit. You can see the marginal cost is very below than the price. Price is very much high, right? So they compare what happened to the profit, price and everything. So what is our conclusion? We have to check in the perfect competition. No, that is our focus. If the market reaches to perfect competition, at least they can settle at a point where their price equals to marginal cost. So they will avoid the loss. They will settle at normal profit, but that is okay. That the overproduction also reduces. The price will little bit go up and ended up their price equal marginal cost. Then they compare the scenarios as well. So if we introduce a perfectly competitive model for this for dairy industry, price will go up, price will equal to the marginal cost, losses would avoid, they will earn normal profit and overproduction will reduce, right? So these are the answers I expect. What happened when the perfect competition is introduced? So what is the next question? What are the welfare effects? That means consumer surplus, deadweight loss of moving away from perfect competition. Now here, it's like this. This is Q, P. They have quantity demanded here. This is their demand. This is the MC. Now, before they were somewhere here, QO, overproduced with a lower price. Now, if they move to this point, what happened? This is perfectly competition. Now, price equal to MC, no profit or loss, normal profit, the quantity reduced. And if we compare what happened to the producer's surplus then, and here they suggest if the supply management policies are introduced, this is where we go here. Okay. Now tell me what is the welfare? When we are talking about welfare, we think about two things: consumer surplus and producer surplus. Okay? Now here, let's compare with perfectly competition point and supply management. Okay? What is consumer surplus? Which area we have as a consumer surplus? It's right. Now, at perfect competition, this is the price producers pay. But they are willing to pay this much of higher price. But they save it. So this entire triangle is their consumer surplus. And here under this price, this much of quantity now sellers sell. So we say this is their income. So this portion they get at the sellers here. This portion consumers. Okay. Now what happened? When we introduce this management or the supply management policy, we are going here. This is the price now the consumers have to pay. Now this is the quantity at this price the suppliers will supply. So this entire part, it's okay, right? It is going to be taken by the producers as their revenue. This part is taken by the consumers as the consumer service. Then what happened? If we compare the entire welfare and now this part is totally lost. Neither producers get or consumers get. So this is dead weight loss, right? Let's say this is some benefit because this is overproduction. They wanted to reduce the production. Okay, this is expected. අපි එහෙම හිතමුකෝ. මොකද අර මේගොල්ලෝ මේ අඩුවේ කෑල්ල මෙතනින් යනවනේ. How about this part? Even though producers miss this part, they get additionally this part. Consumers like a triangle. But how about this part? That small triangle, none of them get. No? Producers or sellers are they're going to make. So we still get them. Right? So you don't have to remember these things very like clearly. But get the idea. When we are interviewing government intervention, this is the management, supply management policy. If it can be tariff, right? It can be maximum price or minimum price intervention. If the government intervene and influence the market always, there is a debt weight loss for the society. Understood? So under perfect competition, there is zero. The freely the market is freely operating. Right? The welfare is maximum. Market is economically efficient. Allocative efficient is there. Productive efficient is there. But when you are deviating away from that by in the form of government intervention, what happens? Some part of welfare is going to be lost for the entire. Understood? So that's the lesson we have to learn. So this perfect competition is an ideal market to maximize the welfare. What is the other question? In the long run, why would economic profits in a perfectly competitive potato industry tend towards zero? What happened in the long run? Not directly from the case study. Let's say now they are making profit in the short run. Why these profits are like minimizing or deviating, alleviating in the long run? What are the reasons? We learned them today. Because this abnormal profit would attract new firms. So when new firms are there, the factor prices would go up, cost would go up. So your average cost, marginal cost, everything goes up, alleviating the profit. Or else, profit will motivate the existing firms to produce more. So then they will produce more. When the supply increases, the price would go down. So either input prices go down, thereby result in higher average cost, or the final price would go down, thereby result in lower profit. Either way, they are settling at normal profit in the long run. Right. All other things, I think, for you to, for extra knowledge. But overall, from this case study, what you have to learn is newly what is happening to the welfare if we are moving away from the perfect competitive firms. Okay. Right. Can you tell me the last question as well? If government subsidies or tariffs are introduced, how would they affect the competitive nature of the industry? If we introduce tariffs, what happens? What happens? If we introduce tariff or subsidies, what happened to the competitiveness of the industry? Increases or decreases? Think carefully. What happened to the competition, I ask? Competitiveness. Okay, let's think about subsidies. Now, please discuss again. Now, the government introduced subsidies for these potato farmers. Like they provide incentives to farm potatoes. Now, what would happen for the prices and everything and ultimately the profit or loss in this market when the subsidies are given? What will happen to the cost if the subsidies are given? What happened to the cost? Cost will reduce. Then what happened? Supply will increase. When the supply increases, what will happen to the market price? Market price would go down, right? Then what would happen? What would happen to the profit and everything? When the market price goes down, what would happen to the profit? Increases or decrease? Decreases. Then what would happen? Firms will attract or firms will leave? They're not attracted, no? There's no abnormal profit, no? Then what would happen to that DN? What would happen to the competition? Increases or decreases? When there are small number of firms, when the firms are leaving, competition increases or decreases? Decreases, right? Anything that is like artificially introduced to the market results less competition. Understood? A perfect competition තියෙන එකට තමයි ඒගොල්ලෝ ප්‍රශ්නයක් ගේන්නේ intervene. So any government intervention in the form of price increase, maximum price or minimum price or government subsidies, import tariff, import quota, anything would reduce the competition in the market. Free market competition maker, they will change, right? They will reduce. Understood? Okay. So we will take the break now. And we are having the next session somewhere else, I think in the the lab, no? In this building. Right. So at what time you can come? By 12, can you? No? Huh? 30 minutes is not enough. Huh? 12:30? 12:15 then, okay?